Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Really glad that you could join us. Our objective in this show is to try to help you have a more successful retirement. Whether you're looking forward to retirement or you're already in retirement, we do kind of a question and answer show here. And you can send in questions here at Ask Tom with talkmoneywithtom.com. You can post questions here in the chat, and we'll try to answer those as best we can. We have Eason here today again. He's going to be the one kind of, curating the questions and asking the questions, and then we'll go back and forth and try to fill it out. We believe really strongly that your education level in the areas of retirement planning and tax planning and investment management will help your retirement. The more you know about those three areas, again, the better you'll do, whether you're about to retire or you're going to retire in a long time or you're already retired. All of these things can have an impact. We get some of these questions during the week. You can feel free to send those through. We get some suggestions for questions that come up in some of our strategy sessions with clients. So, we try to round this out as much as we can also. So if you are interested in continuing to get the updated content from this channel, we're putting out content pretty much every single day that goes into this channel. You can subscribe to the channel and then you hit the little bell button, you'll get notified. And if you'd like to just do something more custom and ask us some specific questions about your situations, you can set up an appointment. We have a book appointment button on our website. You can get to the website right here through this channel also. Maybe a half-hour appointment, a phone or video, and you can tell us, kind of your specific situation. We can see if we can help out as far as that goes. So really fun show. Very glad that you're able to join us today. And let's get started with some of the other pieces that I like to do here. I like to start off with this kind of summary of what I saw happening in the market this week. As usual, this week was very fascinating. This has been, ever since this pandemic started, week after week, it's been kind of a little bit of a different story. Been a fantastic stock market altogether, which has been really fun to talk with and to invest in. But this particular week, we had quite a few different cross currents. We had the situation with this new variant, this Omicron variant that came out, and the market, last week took a hit because of that. It seems like that fear is fading somewhat. They've done some testing, found out that the vaccines are, at least decent against this particular variant, and the cases so far have been mild. I think we have some room to grow there in terms of our knowledge about what's happening. But I will say in general, one of the things that's happening, if you look at the data, people are moving around again, and economic growth is happening irregardless of what's going on with the different waves of the virus. Every wave that has happened, the economy has been affected less. Essentially, what is going on is we're learning how to live within this virus. And so economically, unless something changes pretty radically, I'm not sure the virus is the biggest story. The bigger story really right now, in my opinion, is kind of twofold, and they go together. One is inflation. So they just reported the inflation number for November was 6.8% higher than last November. So that's a big number. Got to go back to 1982 to find a number that's bigger. And then the second issue has to do with the Federal Reserve and what they're going to do about inflation. So let me try to describe kind of what's going on here in this kind of teeter-totter situation that we'll find ourselves in. And there's some opportunity here and there's some risk here. And it's important to kind of understand, what's going on. So the risk to the market with inflation just has to do with the fact that as inflation goes up and up and up and up, if it keeps going up in an unchecked manner at these rates, it's going to strip out the power of the consumer. So if inflation goes up 6.8% and somebody has 6.8% more money and they can still buy the same things, that doesn't affect earnings in the end. And that's the key. Got to always focus on earnings and what might affect earnings. And we saw that pretty much in the third quarter earnings reports. We had a 36% jump in earnings, over the third quarter from last year, even though we had an inflationary environment. That just means that the consumer can kind of keep up with that. And what we're seeing right now, some interesting data. If you look back to January 2020, before the pandemic started, to now, consumers are spending 25% more. Just saw this study today. That's a huge jump. And so the consumer is very healthy as far as what they're doing in terms of expenditure. And I saw another report today that said household wealth here in the US grew 36 trillion that's with a T, trillion dollars since the end of the first quarter of 2020. So basically the bottom of the pandemic, as far as the economy and the market goes, to now. So there's this huge wealth buildup. There's an income buildup. There's all kinds of different money that people have to spend even if costs go up. But eventually costs can go up too much and get past the ability for the consumer, whether that's a business consumer or a personal consumer, to spend. And then you get this scenario where that would affect earnings. So on the other side, you have the Federal Reserve, and their objective is to try to stimulate the economy up to a certain point and still keep inflation kind of in that 2, maybe even 3% range. And so how are they going to respond to this? And so when you hear about inflation, really what you want to focus on, in my opinion, is how the Federal Reserve responds. Historically, at least for the last many, many years here, inflation has not been the thing that has brought the stock market to its knees. It's really the Federal Reserve, and ultimately it's because they're over raising rates. So if you go back to 2000, 19 rate increases, we end up with a giant bubble burst. You go back to 2008, 21 rate increases, we end up with really the second biggest downturn since the 1900s. And if you look at even 2018, many of you probably don't remember this, but we had nearly a 20% drop at the end of 2018. We had this kind of trade war going on with China, economy starting to slow down, and the Federal Reserve in their infinite wisdom continued to raise rates, and we ended up with this stock market downturn until the Federal Reserve finally woke up and said, okay, things are slowing down. 2019, they started lowering rates, and we ended up having a really good year in 2019. So I would focus more of my energy on what the Fed is doing, and they made a pretty radical change last week, and that had to do with the fact that they had very clearly spelled out what they were going to do in terms of rate increases and cutting back on these bond purchases. And they decided to become much more aggressive in cutting back on those bond increases. Although it hasn't been officially announced yet, the meeting next week with the Federal Reserve, they'll probably come out and say that they're going to cut back on their purchases of bonds, 30 billion cut back instead of 15 billion cut back per month. And so that's the environment that we're in. So there is this kind of Goldilocks zone where the Federal Reserve does enough, cutting back on stimulus and raising interest rates to allow things to continue to grow at a nice pace, and inflation doesn't end up at a high spot. But we've got this crazy teeter-totter right now where you've got this potential inflationary environment that could bring down earnings if it gets out of control, or you have a Federal Reserve that could get out of control and raise rates too much. And so we want to find that kind of middle ground. And it's going to be complicated a bit for the Federal Reserve because we're in the middle of a pandemic. So they could be slowing down, the economy, and then we get a virus that ends up slowing down the economy. And so they're going to need some flexibility there. And I think that's what we're seeing. And right now, if you look at the bond market, the 10-year Treasury bond market is fairly high. It's come down off of its highs. And again, that just usually means that the bond market looking forward is expecting inflation to be somewhat more moderated than it is right now. We're even seeing what they call the yield curve, the 10-year, 2-year, 10-year, 30-year kind of flatten out. That's generally a sign that there is some economic slowing in the future, which might be a good thing because the economy is really hot right now, and that's what's causing some of this. So these are good problems to have in terms of what we look at in the stock market. Demand dropping is a problem. So actually, I look at what's happening in China with this Evergrande, company that has this huge real estate portfolio and $300 billion worth of debt. They're suffering from demand dropping. There isn't enough demand for all of their apartments that they've made. There isn't enough foreign demand for the bonds that they've got. That's a bigger issue to me when demand drops. And those are the issues we saw certainly in 2008. But what we're seeing right now is actually demand, overall across the world and here in the U.S. is pretty high. Again, there's 36 trillion more dollars in American households. It's not evenly distributed, that's for sure, but there's more dollars in American households than there was, and so that gives some more buying power, and that allows, at least so far, people to kind of keep up with inflation and not impact earnings. But that will be the big picture looking forward, is how does this play out? So really look forward to talking to you some more as we go. Very fascinating time. This is the time to start keeping your eye on the ball, because this scenario we're going through right now will be more difficult than what we've been through in 2020 and 2021. We'll probably see more volatility in the market, but if rates are still low, and you see volatility and it starts to come down, those might be some buying opportunities until those rates start to get higher or they start to really get aggressive, even in their talking points and such too. So that's what we'll be watching for, and we'll see how this plays out. So look forward to seeing what's going to happen next week. All right, Ethan, let's chat about what we have as questions so far. Oops.
So you talked about the market saw a 6.8 percent inflation year over year.
Yeah.
Why is the market still going up today? I know expectations were 7 plus, but I don't feel like 6.8% versus seven's that big of a difference.
Yeah, I think there's a couple things that are going on. And there's one basic to understand, and this would be a great thing to get your head around if you can when you're looking at the markets and what might happen, especially in short term moves. There's expectation and then there's reality. So when you look at what's going on, probably on average, I'd say the expectation was that we would hit 7.1%, right? So some of the movement that we've seen coming into this day has been reflecting on this higher inflation number. And so I'd say three quarters of the movement of the stock market is looking forward, and one quarter of the movement of the stock market, these are just round guesses, but one quarter of the movement of the stock market has really to do with the reality. So expectation at 7.1, reality at 6.8. Oh, so now we get a reset in a positive way. In this case, the stock market comes up. If we would hit 7.5 and the expectation was 7.1, we would have seen a negative reset because of the reality. So there's this expectation, and this happens to individual companies constantly, certain expectation for earnings, and they either beat that or don't beat that. Expectation for the guidance that they'll have going forward, and they either beat that or don't beat that. And that's how things are kind of adjusted in reality, as far as that goes. So I think, there obviously isn't a significant difference between 6.8 and 7.1. It has more to, and we're not seeing a huge run up in the market either, but the adjustment we're seeing here has to do with the expectations versus reality. And that goes on all the time as far as that goes. So, there's some expectation that inflation is going to continue to be quite high. Well, if it isn't, I think we'll see some adjustments going forward to a better stock market. If it's worse than expected, right? Just long term, not just today. Let's talk about November of next year, right? So I think things are really interesting. So November of next year, we have a couple things going for us that could create lower inflation. Number one, we're not comparing ourselves to November of 2020. I think that's a really big thing to understand. The number that comes out at 6.8 is year over year, November of this year versus November of last year. Think about November of last year. No vaccine, mobility data was significantly lower, and the economy wasn't where it was now or is now because of this, reopening and people starting to live with the virus. But if we talk about November of 2022 next year versus this November, could be a completely different outlook as far as that goes. And I would bet anything that one of the major drivers of inflation is the supply chain issues. Those become so much less a year from now. And so that those two issues, kind of a year over year comparison that is more probably accurate, and then this scenario of supply chain. I think labor continues to be a problem, and that, we're increasing the price of labor, right? But and that's hard to get back. But I do believe supply chain issue resolves itself. So we could see some. My overall guess right now is that the outlook for inflation for 2022 is higher than we might see it. And so that would create a positive impact on that adjustment. So if inflation comes out at 3% in November of next year, and people think it's going to be 4 or something higher than that, then we would see again, that's that adjustment to reality. That's what's happening today.
So you talked about the Fed, and they're having that meeting next week. What should I be looking out for? Is there any kind of like phrasing or like keywords that I should be looking for when reports come in, what they say?
Yeah, the Fed's funny, right? I mean, a lot of people don't understand. I mean, matter of fact, my most common conversation with clients about the markets has a lot to do with who's president or what Congress is doing and those types of things. And then there is some impact there. Uh, but I tell you what, who's Federal Reserve chairman and what the Federal Reserve is going to do has some way more impact on your stock market portfolio. And so, almost every hiccup, every word that's said is analyzed, and you can see it. I mean, I watch the minute by minute charts, all day. I have one up on one of my screens here. And so, boom, you'll see it drop a lot or come up a lot just right as they're speaking. I mean, especially it's Chairman Powell. He's pretty good. I think he does a good job. But they did do a fairly radical movement from being very clear about what they were going to do in the future and very clear about the small increases and things that they saw coming to testifying in front of Congress last week and just really talking about inflation's not transitionary anymore, and we're going to be looking at more aggressive measures to cut back on stimulus. That was a fairly aggressive change, so that's what I want to hear. I'm not expecting to hear much different. We do need to keep in mind there is a political component here that we have to be aware of. So the White House has nominated Chairman Powell again to be the Fed chairman, but he has to be confirmed by the Senate. And so what they're going to be going through here is this whole question and answer period. If I'm standing in front of a whole bunch of politicians who are looking at their votes, they're going to be asking me about inflation. What am I going to do to fight inflation? Because every one of the people that is voting for me is dealing with inflation. Now, if I fight inflation really hard, it can bring down the stock market, but not every person that's going to vote for me has exposure to the stock market. So that's, I think he's going to want to be going into those confirmation hearings with this backdrop of, hey, we are getting more aggressive. Maybe once he's confirmed, we might hear a different story. I'm really hoping that the Fed can stay flexible. So that's what I'd be listening to for next, is how flexible they can be. They were raising rates, and Chairman Powell was in 2018 when they shouldn't have been raising rates. Bond yields are dropping, stock market's dropping. We're dealing with China and all these things that are going on, and they kept raising rates, and the market came down quite a bit. So that's what I'm listening for. I don't want that to happen again. They did finally, adjust themselves, but I don't know. If you watch the market, I'm not sure what they were looking at and why they were going up during that time frame, because it didn't make sense. So that's the type of thing that can happen next year. If they're getting real aggressive, even their talk right now in the middle of this new variant and the bond market coming down, it's like, okay, we'll see what happens there, because essentially the bond market is saying the economy is not going to be as hot when it comes down. But again, there's other issues and other variables, but that's one of the main messages we get out of the bond market. So uh, I'm watching for how aggressive they're going to be and how flexible in their wording as far as that goes. And so, again, I think you're going to hear more aggression until he gets confirmed, and then we might hear some other issues. And so that's just something to think about. I could be wrong there, but, we'll see. But important.
Is there anything I should be looking out for outside of the Fed meeting next week that could cause volatility in the market with like the debt ceiling, the Omicron fears kind of clearing up, just in the short term, end of the year into January?
Yeah, I would say Omicron's still a story, right? So that's something, although I don't think it'll be a big story. I'd be much more concerned about what's going on in China, right? I think that's an issue. Because again, the problem we're having in the inflation is too much demand. That's a good problem to have. Still a problem, but good problem to have. The Federal Reserve, hopefully they've got their thoughts lined up and they're going to be flexible and they're going to do so. Again, that is going to be important. But what's going on in China is a demand, lack of demand, right? So they've got this big real estate company. Apparently there are other real estate companies there in China that are having some problems also. And generally speaking, the Chinese government has stepped in and kind of bailed out these situations because they want to keep a positive relationship with foreign investors. We all do. Every country relies upon foreign investors to really work in today's world. And so they allowed this company to default sort of. They didn't make payments on two of their bonds, and they're having trouble issuing new bonds to kind of gather more money because again the demand has dropped down. There's been some things going on in China where they're kind of moving sort of away from the capitalistic process that they had been moving towards. It seems to me, and we're getting some issues with a lot of their stocks doing fairly poorly because of that, and a lot of foreign capital is fleeing. So um, did they not bail out, this big real estate company because they just want to make an example of that company because they got too carried away? Or did they not bail out that company because they're worried about the precedent and maybe they won't be able to bail out everybody, right? So I would say that's something that we're going to hear more about between now and the end of the year. The market took it in stride yesterday. We had a little bit of a drop. I didn't, as that news came out, I didn't see on the kind of minute by minute chart a big jump or drop or anything along those lines. So I think that news is kind of baked into what's happening, but there could be continued issues there. Again, that lack of demand is a much bigger problem, and that's something to focus on. And that's what you're seeing right there in China right now. We're seeing lack of demand in their stock market. So there's some teetering going on there, but it is a centralized, controlled government. I don't think they're out of money. They're still a very large economy doing quite well as far as I can tell. And so I do think they come in and kind of restructure things and figure out how to do this. But, we'll have to see. But I'd say that's what I'd be looking at besides the Fed and the virus.
Yeah. So back to a more planning question and the beer question. I heard the term wash sale used a couple times on the show. What is a wash sale and why is it so important?
Yeah, so wash sale is let's say that I have a loss in something and I want to capture that loss. Let's say it's Ford. Ford's up, but let's just say Ford is down for me for some reason. And I have a $20,000 loss and I have some other gains for the year and I want to take that loss so that I can write it off against those gains. So let's say I have a $100,000 gain altogether from all my work that I did this year and I want to sell Ford, take the $20,000 and basically save some money. I mean, that if I'm in a 20% tax bracket, I'm going to save $4,000. So that's good. But if I buy Ford back within 30 days, it's disallowed. I can't take that $20,000 write off, and that's a huge problem. So now I can buy something else with that money, but I can't buy Ford. Uh, the one big gray area here that's really interesting is try to look this up. I mean, there's very little information. What can I buy? Theoretically, it has to be something that isn't substantially similar. What does that mean? It's a kind of a gray area. So can I go out and buy an auto ETF? There's one called CARS, CARS is the symbol. Can I go buy that when I buy Ford? That becomes a little bit of a gray area as to what you can do. Can you go buy Apple? Yes, certainly. And maybe you should, but that type of thing. So that's something a lot of people don't understand. You have to be able to wait. Now you don't lose that $20,000 loss altogether. It becomes part of your cost basis, but obviously you're trying to get the write off right now so that you can save some money on your taxes.
Yeah, and like also like index funds, they can be very similar. So if you go from like S&P 500 index fund to another S&P 500
Right.
index fund, that would be considered a wash sale.
Yeah.
Even
That.
if they're like two different companies, it
Yep.
wouldn't matter.
That's right. Yeah. So try to find something that's different, and substantially different as much as possible. Again, there isn't a lot of cases out there. The IRS doesn't seem to pursue it that much. It's very obvious when it's the same security. There was some story that came out of last year with a guy that I'll just make some of these numbers up, but he started with 40,000. He ended up with 50,000 and he traded the same stock in a taxable account like 1,000 times, right? And so he made money. It was good. But he had gains and losses on all these different trades. So let's just say, for example, I believe the number was about $800,000 worth of gains, and then $790,000 worth of losses, right? So he ends up with a net of $10,000, and that's what he'd have to pay taxes on. But he kept trading the same stock and not waiting 31 days. And so all of those losses are disallowed, which if he would have realized that before the end of the year, there's some things he could have done, but he didn't realize it until the beginning of 2021, which just means that now he has an $800,000 gain on the books. Taxes on that are going to be maybe $175,000. And you can't go back, can't change it. Got to pay the tax. Now you could get a big write-off loss in that 2021 year when you do sell it because your cost basis grew, but that doesn't really help you. You're still going to have to pay that tax. And so it was just a cautionary tale about understanding the wash sale rules, especially for these people that are kind of day trading in a taxable account. If you're doing that in an IRA or something, there's no issue there as far as that goes. If you're doing it outside of an IRA, that's the issue, because you don't care about the being able to capture the loss in an IRA because you can't take it anyway. So yeah, it's an important thing to understand, and there have been some issues, that have come up in the press recently. A lot of new investors out there right now. The whole Robinhood thing and last year's pandemic drove a lot of people to investing. So it's just something to be aware of.
Yeah, and when you're trading and it's not your profession, taxes you can't write off losses as well on short-term gain,
Yeah,
or it just makes it brutal. So you gotta
yeah,
be pretty careful when you're doing day trading of any kind
yeah,
into
yeah.
the taxes.
Especially in a taxable account. Yep, I agree. That's for sure.
So our next question is, Tom, I read a article that said around a quarter of respondents to a Goldman Sachs survey said they plan to retire before 55. What big changes do I need to make if I'm going to retire a handful of years sooner than I originally expected?
Okay. Yeah, it, it it's kind of funny. I've seen an awful lot of news talking about how many people want to retire early. Personally, I've been doing this for 35 years. That's been something that's been going on for as long as I can remember. Generally speaking, that's kind of a great thing to think about. Being able to retire early, right? Very difficult to do. so, and so oftentimes people can't do it. I mean, they might want to do it. It might be 25 and think I'm retiring at 55, and they get to there and they realize life got in the way. They got, kids and a house and a mortgage and all these things, and didn't, become as rich as you thought you would be, when you're younger. So I'd say that there's a couple of things that you have to think about there. First of all, can you do it? And so that's where I think, financial planning, Monte Carlo simulation, and those types of things come into play where you can test that out, because you're now asking your money to last longer, right? The rest of your life, whatever that might be, is, let's just say 85 or 100 or whatever it is that you think you might live to. When you retire at 55 versus 65, your money has to last 10 years longer. Um, and so and you have 10 years less to accumulate money, as far as that goes too. So that's what makes it super difficult. That would be one thing I would consider. The other thing is, and again, it depends on how old you are when you start considering this. You cannot get to your IRAs or 401ks or all these other type of savings assets prior to 59 and a half. So if you're going to retire at 55, and you want to get into those assets, you're going to pay a penalty to do so. There is a thing called the Rule 72T, which allows you to take money out of those retirement assets. And if that's all you have, that works quite well, but it has some restrictions. And if you have some time, it'd be better off building up some assets outside the IRA. So maybe you give up a little bit of the contributions to the 401k and put that money into kind of a regular taxable liquid account, just to bridge that gap from 59, from 55 to 59 and a half. Never cut back your 401k past the point of the match, right? So if you're, whatever your match is, get that, because that's 100% rate of return. But past that, there's some things you might want to consider if you are going to retire early. Make sure you have some assets outside of retirement plans, in my opinion.
So for like retiring early, you basically, if you're starting to think about it, you should be really ramping up your savings rates if you're really seriously considering it.
Yeah,
I think now there's so much wealth of information about retiring early.
yeah,
A lot of people talk about it, and you see these stories where people are saving 50 to 70% of their income just
yep,
so they can retire early.
yep. Yeah. And sometimes that's what it takes. It depends on how early you think of that and how what time you have left before this early retirement age. Uh, and I think yeah, it goes on both sides. You've got to restructure possibly of your life to be able to save. I mean, that's a huge savings rate, like 50, 60, 70%, right? Um, and you got to keep that mentality at least for a portion of your retirement. You got to keep that low cost mentality. I think what you're looking at personally is I'm willing to trade my some of my lifestyle and live a simpler life in exchange for not having to go to work every day. I think that's fair. There's nothing wrong with that. It's those people that say, okay, I want to spend $400,000 a year. I've saved up $1 million. I want to retire at 55. Well, I hate to tell you, if you do the math on that, it's not going to work. You're not going to get to 85 with that money. You're going to spend it all out. So again, it's just kind of finding that balance. And as long as you're willing to kind of trade. Now, if I have $10 million and I'm 55 because I was in part of a startup, or okay, those work, right? But the numbers have to work as far as that goes, and what you're willing to spend has to fit really well within the assets that you do have, because you're not going to get Social Security until at least 62, and maybe even 70, depending on what you end up doing. And so, how do you get by for all of those years and such too? So. It does take a mentality shift, and you're trading off one thing for another. For most people, it means trading off some extra lifestyle benefits in order to have a lifestyle benefit of not going to work. Right? That's okay.
Yeah, and so that kind of brings us to our next question. What's the difference between financial
Mm.
independence and retirement?
Yeah, that's a good question, actually. Perfectly timed. Uh, yeah, so we've been running into this a lot where people will say, especially here in the valley, we run into people that it's a hard job. I mean, they're really grinding out a lot of hours, that kind of 50 to 80-hour weeks that are happening. The tech business is very demanding. And so they just want to kind of get out from underneath that, but they don't particularly want to retire. Maybe they're 60 or something along those lines, and they just want to get out of that 50 to 80-hour week and do something else. And I call that financial independence. So you want to get to a spot where you could not work, or if you did work, it wouldn't matter that much what you were making. So, you could go from being a tech executive to working at the yarn store, because you really like knitting and you're excited about whatever it is, kind of get involved in some of your hobbies that don't pay that much as far as that goes. So I think that's an aspect that I think is really, cool to look at. And that's what we call that financial independence. So instead of a pure retirement, I've heard a lot of people say I don't really want to retire, but what they are looking for is a point in time where either they could retire or do something else that wouldn't pay as much, but they might enjoy more or not be 50 to 80 hours, that kind of stuff. So that's what we call financial independence. And that's generally what we're working with quite a few of the early retirees. It isn't that they want to completely disengage from working, although some do, but most want to do something else and be able to do something else. That's the objective.
Yeah, and even if you don't reach financial independence, we could test the theory is say instead of earning 200,000, what if I earned 100,000, but I was able to maybe maintain three-fourths of my savings rate?
Yep.
Uh, like, would that work for me to get to retirement at
Yep.
65?
Yep.
And those are like scenarios that are pretty common that we can test. Maybe this job is just it's grinding you to the bone and you're just done with it and you
Yep.
need something else.
Yeah. Recently, we were talking with a client about just trying to find the number right now. Because the job's a grind. It's been really hard. Things are, and especially been, it's been tough for the last few years. And um, and just knowing what that number is. Maybe it's not that much. Maybe, hey, I could retire right now with 40,000. I don't really want to, but if I hate this job that much, maybe that's a worthwhile trade-off. But it's not even that. It's more mental. It is like, okay, this is what I could generate, and according to Monte Carlo simulation, and being an 85% or higher time, success rate, I could have X amount of dollars. And I just know that right now. I've already got these assets built up because I've been working so hard. And I know right now I could get this. And I don't really want that. I'll keep working, but it makes it easier for me to keep working knowing what I do have. And so that's something you can kind of do on a year by year basis, just kind of see what it is that you could be having, for your financial independence. Again, it might not be enough to really do what you want, but again, if you had to trade this job that was killing you for whatever reason, for, this lower income, at least for a while, so you could transition to something else and, hey, right? Maybe go back to school and become a teacher, right? Whatever it is, you might need some money to get through that time period. So that's another way of looking at financial independence. I think is really interesting. It's partly mental, just trying to alleviate some of the stress and knowing that you could, walk out the door.
So this is a portfolio question.
Mm-hmm.
Why should I keep a portion of bonds in my portfolio when these returns are pretty abysmal and sometimes even negative?
Yeah. Okay, so this is a philosophical differential that I run into constantly with the way that I handle portfolios versus the way that other people tend to think about them. I don't look at bonds as an investment per se. I look at stocks as an investment. Wealth is created from real estate and stocks for most of us, unless you're a superstar like LeBron James who creates wealth by playing basketball or whatever. For the majority of us, we create wealth from stocks and real estate. So I want to have each client have as much stock as they can possibly handle, right? In terms of their own tolerance to risk. That might be 10% of the portfolio stock. It might be 100%, whatever that might be. And so then what the bonds make up in that portfolio is the parachute for when the stock market falls apart. Because literally, you're right. The bond market for the last year is actually down some. But I'd rather be, if the stock market drops 35% and your bonds are down, zero point 0.1, bonds look awesome in that environment. And so what it does is it just allows you to have kind of a parachute. And it's a great analogy altogether. You got to have the right size parachute, right? So if you're going to jump out of a plane and your parachute is this little teeny thing, you're going to fall hard, right? And so you have to understand what that is. Bonds can sometimes go up when stock market goes down. That's what we saw in this last downturn. Not always, but generally they do fall less when they do fall. Like 2008, the S&P 500 was down 57%, something in that range. I'd say the average bond thing that we were looking at was down maybe 8 or 10, still pretty dramatic, but that's a heck of a lot less. Bonds look fantastic in that environment. And so it's the parachute. Bonds are a parachute. Now, you can do some things to try to moderate. I think right now our average return on bonds is positive, just barely, even though the stock market is negative. And so we've done some things with Treasury inflation protection securities. We've done some things by having some short-term bonds instead of so many long-term bonds. But you have to be really careful there. If you do everything kind of really short-term bonds, you just made a teeny little parachute because they don't go up much when the market goes down. And so, again, all of a sudden you're falling out of that plane with, I used to have these little GI Joe guys that had a parachute. That's my visual. So you don't want to have the GI Joe parachute really, because when you're a lot heavier than that plastic GI Joe. So basically, you want to make sure that that parachute is adequate for the risks that you're willing to take. That's what bonds are. And even if they underperform, the stock market's up 25% this year. I don't care if the bond market's down 1%. It doesn't matter to me whatsoever. Thus, we make our money on the stock side. What I'm worried about is the negative 25% in the stock market that could happen. I want to make sure that, those bonds are there to mitigate some of that risk. And that's what bonds are for. And that's a different outlook. People look at bonds as rate of return vehicles. They're looking at yield all the time. They're chasing yield. So right now, if you're chasing yield, you've probably got a lot of high yield bonds. Those drop. I think the stock market was down 35% in 2020. High yield bonds that I was looking at dropped about 23%. That's not a parachute at all. It has a high yield. And we have some high yields in there because it's part of the mixture. But most of our bond mixture is around the parachute, trying to have, some a good amount of treasuries, even though treasuries aren't that great and probably won't be that great going forward. But you never know when we're going to face the next 35% stock market drop, and so that's what they are. And again, not everybody agrees with that. Believe me, I've run into different scenarios, but that's what I've been doing for 35 years, and I stand by that wholeheartedly. Because if you do the bond portion right, it allows people to stay in the stock market. It allows people to have a higher percentage of stocks in their portfolio, and that's where the money is made: stocks and real estate. Those are the two things that we all get wealthy off of, not bonds. I've never met anybody that got wealthy off of bonds outside of the bond brokers like Michael Milken and what have you. So, anyway, that's the answer to that as far as I could tell.
Yeah, and it's really important to stay in the market because you don't want to be selling out at the bottom and then trying to buy in when it's high again. You gotta
Yeah.
want to be staying in that market through the ups and downs.
Yeah, exactly. And it again, the thought process is different. If I'm looking at trying to maximize my return in bonds versus I'm looking at it as a parachute, those are two different portfolios. And if I'm looking at it for pure return, I am most likely mitigating and making my parachute smaller. Dragsters have a parachute on the back of their car that is big enough to stop that thing before they hit the end of their runway, right? And so that's what you want. You want to make sure that the parachute is adequate. And so if you're hunting for yield and doing these different things and trying to maximize returns in your bonds, you're missing out on how it can help you with your stock market portfolio. I'd rather see you have a bond portfolio that was a better parachute, that was even losing more money because it has a lot of treasuries, and add 10% more stock than you might have. So if you're at 50% stock, maybe going to 60, creating a better parachute in that bond side so that, hey, the bonds are detracting and they're not doing as well, but man, they allow you to make the money, the 25% stock market gains like we've had this year. And so that's a big difference. It's a big deal. It's a big piece of what I work on all the time.
Yeah. So let's see if we can get one last question in.
Sure.
Would it be a good idea to take Social Security early and use it to pay off debts such as a mortgage?
Yeah. So you can take Social Security at 62. You got those what they call full retirement age, which used to be 65 for everybody. It was 65 for my father, for example. Now it's 66 to 67, depending on what year you were born. And then, of course, you can wait all the way till age 70 to take it. And so if you take Social Security early, there's a lot of things you can do with it. You can invest it, you can do all these things. We could actually model that, which is interesting. But if it's to pay off a mortgage, if you think about that, I'd say that mortgages we're seeing right now are 2.5 to 4, something like that for most people right now. Social Security will grow at 8% per year after your full retirement age. And so you're going to make more money on the growth than you're going to pay in interest. I like paying off mortgages big time because I do think it helps in retirement to have some room if everything collapses for you to collapse your expenditures. If you have this huge mortgage payment, then it's harder to collapse that down. But I would like to see that honestly, because I think just as a gut feel on a simple question like that, I would say you're better off delaying your Social Security instead of paying off the mortgage. But it is something we can model. We can put that into a financial plan and say, okay, we're going to pay off the mortgage, take Social Security early, or not. Take Social Security later and not pay off the mortgage, and maybe use the extra money past age, full retirement age, that we get from Social Security to fund into the mortgage to pay it off earlier eventually. So, I mean, there's different strategies. My gut feel after doing, so many plans, is that probably you're better off delaying the Social Security and getting those gains than you are in paying off that mortgage. But, and you'd actually have to pay it off too. So if I have a $500,000 mortgage and I could pay $100,000 less, but it's a fixed mortgage, I'm still the same payment. Nothing changes for me until I get rid of it completely. And so does Social Security taking it early actually help me to pay off the mortgage completely? So probably have to be under $100,000 mortgage. There might be other ways to pay that off anyway. Because the object is to get rid of the payment. If the payment doesn't go away, then you're not really accomplishing anything. It goes away sooner if you pay it down, but still, yeah. So anyway, that's a fairly complex question. There's a lot of different pieces that come into play there that I think would be interesting to look at in a planning situation. But it's a good question. Okay, good. Well, we had another great show today. Man, these are really good questions. I hope everybody's getting something out of these, and just in terms of, how this might impact your overall financial well-being, make for a more successful retirement. Again, we are posting content on this channel every single day, actually, sometimes even 2 videos every single day. If you would like to get, updated on these, and, go ahead and subscribe to the channel, hit the like button. And again, you can set up an appointment if you'd like by going to our website and hit the book appointment button, and we can then, take care of your personal needs on a custom basis as far as that goes. So again, I want to thank everybody for joining me. Look forward to seeing you next week. Thank you.